Global Finance, Topic 13A, Competitive Exposure, copyright Lou Gaddis. The objectives for this topic are to understand and recall how to measure competitive exposure and how to manage competitive exposure. Students will also be expected to calculate an approximation for the real exchange rate change. This is the third in a series of topics about foreign exchange exposure. In the first topic, we covered translation exposure. In that case, translation exposure is just defined as paper gains and losses or accounting gains and losses as balance sheet items may or may not have to be revalued at current exchange rates. We also learned about transaction exposures. Transaction exposures are actual cash flow gains and losses as receivables and payables and debt and other foreign exchange transactions are actually come due, and in some cases result into lower US dollar revenues or higher US dollar costs. The example of a transaction exposure is an accounts receivable in euro that you're expecting to come due when the exchange rate's $125 per euro. But when the exchange or when the account actually comes due, the exchange rate is say 110 per euro, and you receive less dollars when you sell the euros and buy the dollars. Now that example may have also been an earlier translation exposure as the receivable sitting on the balance sheet, and in a case did actually come true as a transaction exposure. Competitive exposure is also a cash flow exposure. However, competitive exposure is a long-run exposure to a currency. So for example, if I sell something today and I have a receivable in euros, that is a transaction exposure. However, next year's sales, which have not been recorded yet, will be a competitive exposure. So here's an example. Suppose you're a US-based firm that produces widgets in Pennsylvania, which cost $100 to produce, and then sells them in Germany for 84 euros at an exchange rate of $1.25 per euro. In this case, my profits would be subtracting $100 cost to produce the widget, and then I receive 84 euros. I would then sell the euros at an exchange rate of 125 per euro, and I'd receive $5 per widget. Now, what if by the time you sold the widget and invoiced your customer for 84 euros, the euro were to depreciate by 10%? Well, then my profits would be, well, I'd still have a cost of 100. I still quoted a price of 84 euros, so I'm going to have to invoice them for 84 euros. However, the exchange rate is not 125. It goes down by 10%. So I'm going to multiply times 0.9. That gives me an exchange rate of $1.125 per euro. And at that exchange rate, I actually lose $5.50 per widget. So that would be a transaction loss. Right? That's a transaction loss. I had an account that was sold, quoted 84 euros. I invoiced them. I expected to get 125, but when the account actually was paid, the exchange rate was $1.12.5 and not $1.25, and I lost $5.50 on that widget. By the way, a number we're going to be using later is the US dollar appreciation. So let's just look at that. If the exchange rate goes from 125 to 112.5, the euro is down 10%. However, we learned that that doesn't mean that the dollar is going to be up 10%. The dollar appreciation is actually 11%. So we're going to see that number pop up later, that the US dollar was up 11.11% when the dollar was, or the euro was down 10%. So let's look at this example. Again, we're selling widgets from the US to Germany, making $5. The exchange rate goes down. Now we're losing $5 a widget, and that's a transaction loss. But let's move over to competitive exposure. And competitive exposure is the long run. In the long run, we'll define that as a period of time in which I can change my prices and or costs. So let's see in the long run what we could do. So let's say we first can decide to try to lower our cost. So if we can take the new world, the new exchange rate of 112.5, and we can lower our cost to 89.50. Still, quote, 84 euros per widget at $1.12.5. We could be back to making $5 a widget. But this answer I really find nonsensical in that, well, what gives us the ability to cut costs? You know, if we could cut costs from 100 to 89, we should have done it earlier and made $10 a widget. So let's say this answer is not real viable. So we'll look at something else. What if we can just raise our prices? So say we can't raise or lower our cost, so they're still going to be $100. But instead of charging 84 euros per widget, we increase that by 111%, or I'm sorry, 11.11%, so about 90 some euros. At that new exchange rate, we're back to making $5 a widget. So in the first case, I lowered my costs and I'm back to normal, but that doesn't make sense. Why wouldn't you lower your costs before? In the second case, I just raised my prices. Now, initially, you might say, well, that's a ridiculous answer too. Why didn't you raise your prices before? Well, if I raised my prices before, I would have lost market share. Right? The German widget makers would gain market share. However, you are not going to lose market share in this example for this reason. Let's take our interest rate parity IRP formula, E1 over E0, 1 plus I, 1 plus I. And let's look at dollar price of a euro. So we said our new exchange rate is 112, our old exchange rate is 125. And let's just pretend, and for this case, the US inflation was 0. And we could solve then for the inflation in euro. And it turns out to be that 11.11%. So let's step back here. If the euro is down 10%, it implies Europe had 11.11% higher inflation than the US. If Europe had 11.11% higher inflation than the US, all their good prices, in theory, went up by 11.11% more than US goods. So we just raise our prices by that implied inflation difference. And we don't lose market share because the European producers also raise their prices by 11%. For this reason, we have no competitive exposure to the decrease in the value of the euro. We did have a transaction loss on the last widget we sold. We lost $5.50 on that one. However, if an exchange rate devaluation in this case was caused by inflation, we could see that and just raise our prices. And the next million widgets we sell, we're fine. This is the idea of competitive exposure, that exchange rate changes do not always lead to gains and losses in the long run. So this leads us to a concept of real appreciation. So competitive exposure is a firm's long-term exposure to a currency appreciation. In the long run, you can raise prices and costs, or change prices and costs. Now, what we've been doing for the most of the course is talking about nominal currency appreciations, which is a percentage change in stated rate. So everywhere you look, you see nominal exchange rates at the airport, on the internet, and so in a bank. So everyone in the real world uses nominal exchange rates. However, in finance, we calculate something called a real appreciation of a currency. And a real appreciation of a currency is a nominal rate, nominal appreciation, adjusted for inflation. And as an approximation, a real appreciation of a currency foreign currency is the nominal appreciation of the foreign currency plus the foreign country's incremental, inflation. So the foreign country's incremental inflation. So in our last example, the euro was down 10% in nominal terms, but they had roughly, well, so-called 10% higher inflation. So we say there's roughly no real change in the currency. Therefore, if we just change our prices, we have no exposure to the devaluing currency. There's one other interpretation of real appreciation. So the first appreciation is the approximation. It's the idea that a real appreciation is equal to a nominal appreciation plus inflation differential. And we can also say that based on this theory, or this calculation, and using our widget example, a 10% nominal depreciation, if it were caused by higher inflation roughly, we'd say there's no real appreciation and no one's going to win or lose once we change our prices. There's another interpretation to real appreciation, and that is it's the change in the currency relative to the IRP or PPP expected value. So let's think about that for a minute. So let's look at the last example. If we knew that inflation in Europe was roughly 10% higher, we would expect the euro to devalue by about 10%. If that indeed happened, we'd say there were no real change. So another way of stating that is if the exchange rate simply follows inflation, like PPP suggests, there is never a real appreciation of a currency. So I'll state that again. If a currency behaves according to PPP, meaning higher inflation causes devaluation roughly by the same amount as the incremental inflation, there would never be a depreciation or real appreciation or depreciation of a currency. So here's another example. Suppose you expect a currency to devalue by 5% because they have higher inflation. But then the currency actually appreciates 10%. So you expect it to be down 5. It's actually up 10 in nominal terms. You can say in this case we had a real appreciation of 15, the difference between what it should have done and what it actually did. So it's really just rearranging this formula to think about it. So the important point to this last section is if currencies simply change due to inflation differentials, there would never be a real appreciation. And firms, if they simply adjust prices based on inflations, there would never be long-run gains or losses. So the question is, well, why would you actually have a real appreciation or depreciation of a currency? Well, it comes down to if the exchange rate changes for any reason other than inflation, it's going to cause a real appreciation or depreciation. So the number one thing would be government intervention. If governments are manipulating FX rates, in other words, doing direct currency interventions by stepping in and buying or sell currencies, that'll cause a real depreciation. On the other hand, if countries are manipulating real interest rates, say driving real interest rates low and creating less demand for the currency, that's going to cause a real appreciation or depreciation of currency. Daily speculation on currencies, right, not related to inflation, will cause real changes. Changes in risk perception. For example, when there's new news that the Eurozone is more likely to collapse due to, say, higher increased probability of a Greece default, that will cause the euro to devalue, and it's not necessarily caused by inflation. Also, a demand shock. Say a country has a high demand for a new good. That would cause people to demand their currency to buy their good, therefore appreciating it and not necessarily due to inflation. The example of that is the Dutch disease. The Dutch disease is a special case or situation in the 1960s and 1970s where the Netherlands discovered natural gas. It causes great demand for foreigners to buy the Dutch guilder, to buy their natural gas. The Dutch guilder appreciated in real terms, and also which caused a lot of their industries to become less competitive. Their non-natural gas industries become less competitive. and also maybe just some inflation measurement issues. If I go back to what is PPP, PPP says that exchange rates have to go float according to inflation. If they don't, there'll be arbitrage. In other words, if I found that a Coke is cheaper in Beijing than New York, I could fly to Beijing, buy the Coke, fly back to New York, and sell it. So it's really a theory based on tradable goods. If there are tradable goods available in both countries, arbitrage will ensure that the exchange rates change according to the inflation differentials. However, the way we actually measure inflation is, say, CPI for two countries. And CPI, consumer price indexes, include prices on things like rents on apartments. So if inflation in China is driven by condo prices in Beijing, you're not going to be able to arbitrage by moving a condo from Beijing to New York. Therefore, the measurement of inflation is not what we really would like to use for PPP. We'd like tradable good inflation, but we don't have it. How do we measure competitive exposure? That's really hard. For translation and transaction exposure, it's relatively easy. You identify accounts that are going to be revalued in translation exposure or accounts that are coming due in transaction exposure. For competitive exposure, it's a little bit harder. You have to anticipate nominal changes in exchange rate. Thinking about interest rates, inflation rates, government intervention, supply shocks, risk, things like that. And then forecast inflation. In other words, you need to forecast real changes in the exchange rate. And then you have to look at your price flexibility and your competitors and your cost flexibility in your competitors and see in the long run after price and costs change whether you still are exposed. You manage competitive exposure by having a pricing strategy of being ready to adjust prices according to relative inflation, a marketing strategy which gives you more flexibility in adjusting prices if you have, say, a differentiated product in niche markets, production strategies to reduce costs if for whatever reason there's a real change in the exchange rate and you're less competitive at your production. You may need to delete some unprofitable products or lines, shift production to somewhere that's cheaper, or increase productivity. Funding strategy. For all the exposures to FX, one thing that will help is financing foreign projects and foreign denominated debt. So for example, if I wanted to open a German subsidiary, I would finance the project using euro denominated debt. Therefore, my debt costs and my debt revenues or my revenues are both denominated in euros, and that becomes a natural hedge to all FX exposures. HR strategy, you want to make sure you have contracts that measure performance of managers relative to real changes in the exchange rate. In other words, you don't want to fire your widget manager because he's suddenly not competitive. That's driven by, say, a real change in an exchange rate that was not his or her fault. Accounting strategy, you want to make sure your FASB 52 functional currency is the foreign currency that'll bypass any income statement impacts of FX changes. And lastly, you can hedge with derivatives. Now, let's look at some of Japan's lessons for China, because China is now in the game of preventing their currency from appreciating. And they're doing that because it keeps their exports low and keeps job growth high. However, the negative effect of a strong currency, or caused by government intervention, is that they would like their currency to appreciate just so they can have more purchasing power. So if the yuan were stronger, it would be cheaper for them to travel to America or travel to Europe or buy oil or buy other goods from other countries. Also, we believe that a weaker currency tends to be inflationary. And many feel that this policy is not sustainable, and one of these days the currency is going to appreciate significantly. So what are some of Japan's lessons for China? Well, Japan was in a similar situation several decades ago, say 4 decades ago, than China. They're a cheap source of production. They're exporting a lot of products to Europe and America. And what happened is their currency started appreciating in real terms due to the increased demand for their products and also just that general economic growth that was going on. So what did Japan have to do? They had to create more high-valued items. So they went from, say, Hondas to Acuras. Also, they created luxury brands like Sony. So in order to have more price flexibility and to compete with larger margins, you might need to have a higher quality product. You also need to increase productivity to reduce your costs. So the Japanese were one of the first areas to use really high-tech robotics in creating cars. They also allowed their exchange rate to float for the most part, like allowing the industries to have a little more time into making some of these changes. And lastly, they've moved production to cheaper locations. So they moved production of cars to other low-cost countries, including producing cars in America that are sold in America. And the last slide, just want to show you relative to China, this is a chart that shows the average monthly wages, the dark bar, of China, which is about $500 a month, which is, say, about a fifth of the wages of the US. However, the wages in many countries in that region or in Asia are much lower. For example, Philippines, Vietnam have 1/5 the wages of China. So China is in a situation too where their wages are growing. Some estimates 10 to 20% per year, and a lot of production is being shifted to these lower cost areas. So hopefully we covered what is competitive exposure, how to measure and manage it, and the approximation for real exchange rate changes, which is a nominal change, plus the incremental inflation.